Hey guys, it's me Bao back with another edition of FAQ on trading. Yep, once again in my car. I just ate lunch. Just driving around, clear my head. And today's important topic is going to be on stop losses. How to properly take a loss. Taking a loss doesn't mean that you're losing. It just means that, you know what, you want to exit the stock for whatever reason it may be. One of the reasons may be that you're losing, obviously. Another is because maybe you want to take gains. But we will talk about the scenario where you lost, or rather you want to get out. What's the best way to do it? What is your stop loss strategy, Bao? I get asked that a lot. So this is what I do. So first, next we're gonna make a whole video on sizing, okay? I think people are sizing incorrectly, but for now, let's just talk about what happens when you want to take a stop loss. Assume that you're sized right, everything, and you want to get out of that stock. What do you do? Well, first of all, how do I define my risk, okay? There's many ways to do that stop, right? So I define a risk could be if a stock breaks over a certain line, a certain price, I must stop out. For example, if I want to stop out $5, I'll set a stop loss at $5. I won't go into the nuances of a market stop and limit stop. There are videos on that. Let me just tell you quickly, if you do a market stop, you don't know what price they'll fill you at. If it's a liquid stock, meaning there's a lot of volume, you'll be fine. The spread is tight. If it's an illiquid, be very careful. They'll spread it out and screw you over. So for an illiquid stock, you need to put a limit stop, okay? Just to make sure that you do not get screwed. Just be careful on the illiquid stocks, man, in general, okay? The problem with the limit is if it gaps over that, you're screwed. It won't get triggered. Only a market will get triggered. But a market, once again, a market stop, you don't know what price you're gonna get filled at. But if it's a very thick stock, very volatile in terms of liquidity, then you're fine. You can look up more on that, okay? So let's get back to what we're talking about stops. So the most basic type of stop is a price. You want to stop out at $5, you'll stop out $5. How do you determine this price? Usually a lot of people put on, if you are shorting a stock and it breaks a certain resistance line, now becomes bullish over that, you stop out. So a lot of people do that. Or if it breaks under a certain point, you want to get out if you're long, for instance, right? Now there are pros and cons to that. The pro is, okay, that's standard, that's good, that's right. If it's over $5, it's bullish, you get the hell out. Done, no problem. The negative, you gotta be careful about this though. Everyone is putting their stop at the same price. And so there are a lot of games going on, okay? The game is done by these algos, these high frequency trading, whoever. They see all the orders out there, guys. So first of all, I don't do physical stops. I do mental stops. So I'm a full-time trader, so I'm lucky enough to be able to sit around and wait. And then do the manual orders myself. So I do everything manual orders. If you put out an order, physical order, they will go and scan the market and look at all the orders and see if they will sweep you just to screw you. So a lot of times they'll break over $5. You'll stop out, they'll take it right back down. They've already done the math. They've already done the math to see all the open orders, to see if they can match the orders. It's all order matching, okay? And so that's the danger, first of all, of putting a physical stop loss. So, but if you're at work, you have no choice. Putting it at the same price that everybody else is at, I call that's the sheep mentality, okay? You don't want to be part of the herd, because I'll tell you what happens now. A lot of times, if you're part of the herd, you get fleeced. I don't like to do my stops at the generic numbers. For me, it's actually rare. I'm actually the opposite. I don't stop out at those numbers. I'm entering at those numbers. So here's a secret. This is a little tip, okay? If you find yourself always stopping out at either the top or bottom. If you're short and you're always stopping out at the top, it means you're part of the herd. Do the reverse, guys. So instead of stopping out and losing every time at the top, first of all, you don't know what the top is, right? It's obviously we don't know what the top is. So, but if you're always stopping out, it appears to be the top all the time, you're part of the herd. So instead of entering before that stop, do not enter your position. Wait for that stop and enter during that stop. So I like to do the reverse of what people like to do. So if people are stopping out at $5, I am shorting at $5. You see how that works? I'm doing the reverse. Because a lot of times I know exactly the prices people are stopping out at, because it's obvious. It's a whole number of, it's like, it's obvious. And so if it's something that obvious, they're going to manipulate it. Of course, there are exceptions and stuff, right? It's obvious. So it depends on a lot of things. Well, I don't want to get into it, but it's tape reading. Since I'm doing all these manually, my stops, I'm looking at the rate at which the volume is breaking that line. If it's with what I call authority, this is my own term, right there. If you break with authority, meaning if it breaks and the speed at which it breaks, basically if there's a lot of volume pushing it up, dude, I'm out. But if it's a slow break, it's like, dude, it barely broke the resistance, so I'm still in. We will talk about that in another edition of how to tape read, but I'm just talking about a trick, a tip, is if you're always stopping out, if you're short and you're always stopping out the top, it means that you're part of the herd, and for you not to stop out there, I would be adding there. The reverse, of course, if you're long. If you're always stopping out the bottom, it means they're screwing you too. They're breaking that, taking your order and moving right back up. So I would be adding instead of taking it out over there. You have to be careful though. Remember, it all depends. It depends on how much supply is out there, how much all this stuff. But that's the trick on stopping out at those whole numbers. I love the whole numbers because everyone's stopping out the whole numbers. I'm the guy that's like doing the opposite. Okay, you always have to look at the lines. What's the next line under that? What's the next line over that? And so you have to be very careful. Some of these breaks are real. They're not fakes. So I'm always looking at how far the next line's away. If the line is really far away, I may just eat my loss. I'm not going to be tricky. I'm not going to think they're tricking me. So it all depends how close, how much the resistance lines are together. Okay, we'll talk more about that in another edition, but we're just talking about the whole number of stops right now. Just basically limit stops at a certain price point. Okay, and so if I'm taking a loss, I can say if it breaks $5, I'm out, dude. I don't want anything to do with it because it's going to go to $6. Okay, and that's the most simple way of stopping out on your thing. I don't really like to do that. I will do that though. So I'm going to tell you something about stop losses. Okay, having a max, better way to term is the sooner you know you're wrong, the less money you lose. The sooner you know you're wrong, the less money you lose. And the reason why people don't stop out and take the loss is because they're arrogant, they're stubborn, or they just don't believe that they're wrong. You can have conviction. Conviction works in both ways. Conviction could make you money, or it can make you go broke. And in my opinion, there are more people going broke through conviction than making money through conviction. And when you're making money through conviction, you're usually not making that much money compared to how much you're losing. Okay, because when you're convicted to a stock, usually you're upside down, and you're like, so if you're in the money and you're convicted, then you hold all the way. So that's a good type of conviction. But most of the time, I see people being convicted when they're upside down. Okay, so that's another good point. Okay, if you're convicted and you're in the money, that's a good conviction. If you're out of the money and you're down on that stock and you're convicted, that's a bad conviction. You should reevaluate what you're doing. Get out until the indicators are better in your favor. That's going your way. You can always re-enter, guys. You can always re-enter. So that's a very good lesson. So we have two very good lessons. Okay, if you're stopping out always at the top or bottom, it means you're going with the herd, and you should do the opposite. The second lesson is conviction. You should be a good conviction is when you're in the money and you're holding it to your target. That's a good conviction. People misuse that conviction to mean stubbornness. Okay, conviction does not mean being stubborn. Okay, being stubborn, you would lose money. Stubborn is not a good thing. Conviction somehow got twisted online as I am down a ton of money, but I'm convicted. That is incorrect, guys. That's another tip. What I like to do though, there's a couple of type of stops I do. There's a price, of course. There's a time, and we talked about that in the MIC a lot. The zombie rule. I won't get into that because that's something we teach at MIC. I don't want to talk too much about it because it's a whole thing in itself, and it will take a whole video. So the zombie hour stops, so those are time-based stops, okay, times of days, and there's reasons behind that, okay. But I want to address this, the max loss. Okay, there's two types. There's a max size. This is something I like to do. Okay, these two types of taking your loss stops are what I do. I don't do much of the pricing because I'm always doing the opposite of what people are doing in those areas. And that's why I find it to be more successful to go against the herd. So I like to do a max size, like I'm going to allot 10,000 shares. That's it, to this position. And so when I do that, there's a couple positives that come out. I know that I can only allow to have 10,000 shares. So I am being very frugal, very diligent at position sizing, positioning at certain levels, because I can only have 10,000. If I know I can use 100,000, then I'm going to be very wasteful. But by restricting it to a small size, a finite size, where I cannot go over, it helps me build discipline. I am carefully staging and scaling. Okay, there's a big difference between adding to a loser and scaling into your position. Okay, when you add to a loser, it means like you've broken the plan. Okay, if my plan is to scale every 10 cents up to a certain line, and I'm down because but that's my scaling strategy. That was a pre-planned. That is not adding to a loser. That's sticking with my plan, because my plan is to have an average size with an average price, and I'm scaling to that. So with 10,000 shares, it could be whatever you do, 2,000. Okay, you break it up. You can break it up into quarters, 1/4, 1/5, whatever the size you want it to be. I personally like to do 1/4. So 10,000 shares, I like to do 2,500 shares each time. And I would give myself, I'll just make it up, like every 10 cents. You know, so I have 10 cents times 4 times, I can be up to 40 cents. Okay? And I stage it where, you know, it's far enough away. Or if I don't really know, I will do even smaller, 1,000 shares. And now I can scale 10. You know, it all depends on you. So there's a pros and cons to that, okay? The bigger the initial size of it that you scale in, because the stock may just hit your first initial order. It may not go through the next levels, right? But if I start with 1,000 and it hits the first level, all I have is a tiny size of 1,000. So the pro and con is the smaller and the wider you do it, the more consistency you're gonna have, because you're trading much smaller and you're giving it more range to move. And that's a whole other topic about sizing, but we won't talk about that. So we talked about what different ways of stops, right? Price, based upon a price, stopping out. Now I'm talking about based upon the max size. Max size, I love to do. That's what I implement. I implement these two ways: max size and max dollar loss. Okay. I will allot up to a certain amount to lose per trade. Usually that should be handled by the max size, because I've already done the calculation of what 10,000 shares, and it goes up 40 cents. I'm losing 40 cents. That's $4,000. Okay. And so you can do that, and it should cover itself. But if you screw up and you start breaking the rule, so now I have 15,000 shares. I broke my first rule. these rules are layered upon each other, okay? And this is how I layer it. I layer it about max size, and then the price, sometimes, you know, and the max dollar amount. Okay, so for me, I break rules all the time because I'm a human being. I get stubborn. I get bad convictions, you know. I just get stubborn, you know. Everyone does that from time to time. And so these rules are layered upon each other. Okay, that's the key. They're layered. And so they're preventing me all the time from just blowing out. If I break those 3 rules, max size, max dollar amount loss, price, I don't know what order of rank you like to use it. A lot of people do start with the price, max size, and the ultimate should be in theory max dollar loss. You do not want to lose over a certain amount. You don't want to lose, for example, if you're at $30,000, you don't want to lose more than $4,000. Otherwise, you go under a pattern day trader, right? Just stuff like that. And so they're meant to be a layered protection, multiple layers, like a gate, a gate community, and then you have a gate in your house, and you have a front door. So those are 3 different levels, right, of security. So I layer those, and max size. That's an obvious one, right? So you scale. Let me talk about now the max dollar amount loss. Okay, this is going to be important because if you, let's say I allocate $4,000 for this loss. Okay, now it's up to you to decide what you want to lose, how much you can stomach losing, right, per trade. So I'm going to make a simple example: $4,000. First of all, I'm going to say the max. So let's say you have a rule that says you can't lose more than $4,000. Okay. It doesn't mean that you let that sucker run until you lose $4,000. That's just stupid. It's stupid. It's the same thing as having a budget when you go shopping. I just got my paycheck. I can't spend more than $500 this week on clothes, for instance. It doesn't mean I'm going to spend $500. I'm going to go look for the value, and if there's no value, I'm not just going to waste the money, right? And so having a max loss does not mean losing the maximum amount. I'm going to repeat that. Having the max loss does not mean losing the maximum amount. The sooner you know you're wrong, the less money you lose. But let's assume that you're stubborn. And so when you have a max loss, a $4,000 set limit rule, you should start thinking about cutting that loss around half of that. When you get to half of that, you're like, oh shit. It should be go, oh shit in your head. Because of slippage factor, because of all these factors, you're not going to be able to just instantly take the $4,000 loss. Okay, the $4,000 can easily be $6,000 by the time you take the loss. You try to hit the, you try to exit, but there's no volume, no liquidity. You know, all these problems. So this is why the zombie rule is important. All these rules, the rules are meant to be layered, and that's the secret, guys. A lot of guys don't understand about this layering thing. So this may open your eyes about layering different types of losses. Okay, and that's going to protect you. The more layers you have, it's just like an insurance policy, guys. I have multiple health insurance policies, and then I'll have a rider on top of that. Then I'll have maybe a spouse's insurance to cover that. So you have multiple layers of that. Okay, start playing with that. And so I'll give you an example. So you have a $4,000 loss, and one time you hit 2,000, you should be thinking, shit, man, this trade's not working for me. Why the fuck am I going to lose another unnecessary $2,000? Start thinking about how to get the fuck out. Okay? The sooner you realize you're wrong, the sooner you're better. And so, most of the time, when you get to that half loss, by the time you exit, you're pretty much losing your max amount. If you happen to fucking let your loser run to your max amount, you're fucked. It means you're upside down. You're fucked up. The stock is no good. You know it's been no good a long time ago, but you still let it go. Hope and prayer method does not fucking work, man. So now what happens is this: by the time $4,000 are hit, you start taking a loss, and usually it's at the same point, the same price in the chart that everyone else takes it. Because by the time you're upside down, you can't think clearly, dude. You're not thinking they're tricking you anymore. You just want to get the fuck out. And by the time you start covering or selling your loss, it's ballooned from $4,000 to $8,000. I've seen it all the time. And you're just sitting there like, what the fuck? I knew I should have got out at 2,000. I just turned a $2,000 loss into an $8,000 loss, quadruple. Usually it's by 2, guys. If you wanted to lose 2,000 bucks, you end up losing 4,000 unless you get the fuck out at half of your max loss. It's a mental thing. It happens to me all the fucking time. Okay, so there you have it, man. Those are the 3 different types of losses. I layer them. You heard it from me first, guys. I layer my stops. And these are the rules I have. I have a bunch of different rules, stop rules, and I layer them. Okay? Start playing with that. Maybe that will help you in your stop losses. And what happens is, it's like you take... So as long as one of those rules hit, you should get out. It's much easier to take a loss early on than it is to take a loss later on. Because later on, your mind is upside down. You're fucked up. You can't think clearly. You're like, I'm losing too much. Might as well just lose it all. And then when you lose it all, you're like, why did I just fucking stop out with some little money left? So I'll give you an example. Let's say you have a $25,000. Let's say, make it very simple. Let's say you have a $5,000 account, and your max loss is $2,000 on that $5,000 account. You should be taking that half of your max loss, right? $1,000. So you let it ride to 2,000. You're like, fuck, I'm down 2,000 bucks. I'm gonna just cheat and let it go a little more. And now it's at 3,000. You're like, fuck. All right. And then by the time I hit 4,000, you're like, I'm gonna take a loss. And then you're like, fuck, it's already 4,000. I only got $1,000 left in my account. Might as well just let it ride, hoping it'll come back down, right? But you know it doesn't. Then next you know, you're fucking wiped out. You lost 5,000 bucks. Your entire account's blown. And then you're thinking, what the fuck, dude? I could have just stopped out at any of those points. I should have stopped out at half of my max loss, which is 1,000. I should have stopped out at my max loss. My max loss got turned into $4,000. I should have stopped out at 4,000. I could still save $1,000 bucks. $1,000 is still better than fucking losing my entire account. When I lose my entire account, I have to now put back in 5,000. Go back to work overtime, drive a Lyft, Uber, whatever I need to do. It's like, it fucking sucks. Whatever pennies I can save, right? And so don't let yourself get into the blow up mentality, okay? Don't just get out at the half max loss. That is the fucking trick, guys, okay? So let's review before we end this, because this will be very important. A couple of things I talked about. I talked about having a max loss does not mean losing the max amount of money. Having a max loss, you should start taking your losses at half your max loss. Okay, half your max loss. That's just a rule. You can change it. The more experience you have, you change it. Another rule. What did we say? We said layering the concepts. Okay, we have to do the opposite. The first one is at the price level. Everyone talks about the resistance and support. Everyone's stopping out at those 2 lines. Do the opposite sometimes. Okay, go back to your trades. Are you always stopping on the top and bottom? It means you're doing the things backwards. You're part of the herd. Don't do part of the herd. Okay. Number 2 is max position size. Okay. Do the math before you get in. All this should be pre-planned. You should know where you should scale in, scale out. And it doesn't mean having a 10,000 max size means to use all 10,000. Always save your bullets, man. Always save your bullets. I'd rather make less money but be consistent. Think about it. I'd rather be less money than be consistent. Okay? The key is to be consistent, guys. And so then at the end, you layer in with the max loss on one of those 3. And with the max loss, it should always be an oh shit number. Okay? Let's say you have a $5,000 account. Your max loss is 2. The oh shit number should be maybe 3,000. So you still have 2,000 or whatever it may be, right? So you always need to have an oh shit, get the fuck out, I don't give a damn what you think number. That's the oh shit number. And you don't want to hit that oh shit number. Usually by the time you hit the oh shit number, you can't get out. So you see how many different types of layers of protection, of risk I am employing on there. So I'm going to explain something. In trading, it's not how much you make. We can make constantly money every day. It can be very consistent. It's that one loss that you should be worried about. That one loss will cripple you because what happens is this. You can have 10 days of green. And during those 10 days of green, you're not holding those gains for the maximum amount because there is no maximum amount. But when you lose, you always lose the maximum amount. And if that happens, just don't wipe your account, guys. Because that one fucking loss day, it plays with your mind because of this. You think you have cushion. Oh, I'm up 10 days. I want to use yesterday's gain, so I'll say today's loss. All this shit. Next, you know, you blew up your account. I've seen it all the time. Guys that have 10-day win streaks, the first time they have a loss day, because they're arrogant. They're like, I've gone. So during the 10-day streak, it's also important how you win. If you broke the rules and got lucky and got away with it, eventually it's going to catch up with you. That's why it's very important to keep to good form, I call it. Keep making good habits, okay? Habit forming trading is key to survival. Habit forming trading, okay? Just because you made money does not mean it was a good trade. You broke a bunch of rules, you made money, is not a good trade, guys. It's like being lucky is not a reliable pattern, not a reliable strategy, guys. So great. These concepts may be quickly spoken through this video, but rewind it, review it, watch this, because I guarantee you, I don't think you ever heard about this layering. All right, guys, I'll catch you next one. Happy trading.